And welcome to ETF Edge, your go-to place for everything exchange-traded funds. The chaos in Ukraine continues, but so does the chaos in the trading community. I'm your host, Bob Pisani, everybody. Where are the inflows and outflows in the ETF community? Let's talk with Arnie Nowak. He's the head of Systematic Investment Solutions, the Americas for DWS. They run the X-Tracker suite of ETFs. Andrew McCorman is the managing director at Wallach Beth Capital, and Charles Rotblatt is the vice president of the American Association of Individual Investors. You know, guys, I can't think of a time when there are so many macro issues for investors to address. Inflation, Ukraine, China, and the Fed hiking rates just the most prominent. Andrew, your specialty is the execution of large blocks of ETFs in and out of the marketplace for insurance companies or pension funds. How are your clients managing these risks, and what are you telling them to do now about Ukraine and the inflation issue?
So obviously we're seeing a lot of trades, a lot of large blocks. Just today we saw a large IEMG, which is emerging markets outflow into GOVT. So they're doing that. They're flight to safety. I mean, treasuries may not be the best place, obviously, to get a return with everything going on in the U.S., but they are definitely risk off at that level. Yeah. So, Arnie, you run several Europe-based ETFs, including several that are currency hedged. Several of them were 15% or so off their recent highs. Tell us about Europe. Is Europe pricing in a recession over there? And can you talk to us about the value of using currency hedged investments? Because I know that that's one of the specialties for DWS.
Yes, thank you, Bob. Yeah, certainly the flows into European ETFs have been interesting this year. Year to date, we're still up around about 100 million in terms of flows across the market in European equity ETFs. However, over the past 2 weeks, flows have turned significantly negative. What we tend to say to our clients is it's very much worthwhile knowing about your risks, knowing about what type of exposure do you hold with your ETFs, because as you just said, Bob, currency hedging or not currency hedging really matters. If we look at the current situation in Europe, equity markets are down, but so are currencies against the US dollar. So when we in particular look at the Eurozone ETFs, the unhedged part underperforms the hedged part by almost 6% year to date. So investors, unfortunately, who didn't hedge their currency in the beginning of the year received a bit of a double whammy here. So it really is worthwhile knowing about the risks in the ETFs.
Yeah, you know, Andrew, he makes a good point. We never talk about this, but he has the DBEF, which is the EFA, Europe, Africa, Far East, hedged equity. MSCI essentially tracks the same indexes, but the unhedged one is down much more than the hedged ETF here. EFA is the hedged one.
Yeah, the ETF community has done a great job of putting these products out. Arnie will tell you, this product has been out. And it's fair to say maybe without the turmoil that we're in right now, it was more of an even performance. But you have to pay attention. As soon as something happens, and we're going to have inflation with this U.S. dollar, you absolutely must hedge. So it's a great way to change it. And you're keeping the same exposure. You're just hedging, which you do in a volatile market.
Yeah, it's a very good piece of advice. Arnie, you also run the China A-shares ETF, which is a basket of stocks that trade in mainland China, A-shares. What kind of flows are we seeing in those particular funds? And can you explain some of the very wide discrepancies in some of these China ETFs this year? So your fund, A-shares, ASHR is the symbol, is down about 12%. But the iShares MSCI China, the symbol MCHI, also a basket of China stocks, is down twice as much. It's down 26%.
Yes. So, Bob, again, sort of in a similar vein, it's really worthwhile as an ETF investor knowing what is actually in the ETF. As you just alluded to, ASHR holds domestic onshore Chinese equities. Of course, they haven't done as well as probably some investors have hoped. We saw at the end of last year fairly decent inflows into our product. Those have stalled a little bit and to a little bit of a degree reversed over the last 2 weeks. However, performance has held up, especially when comparing to some of our competitors. And so what I mean by knowing what's in the ETF is, especially when it comes to exposure to China, there is a lot of different options out there. You can invest, of course, via ASHI in the domestic Chinese companies, you know, let's say the 300 largest onshore equities in China. Or you could use an alternative product that invests in Hong Kong listed stocks or even in New York or London listed stocks. Of course, with, you know, the SEC and the ongoing discussion around financial disclosure requirements here in the US, and the emerging talk around potential delistings here from New York, from the New York Stock Exchange. Some of those companies are receiving a worse treatment from investor sentiment and standpoint than onshore domestic Chinese equities. So that kind of differentiation can potentially explain some of the performance differences we've seen year to date.
It's really kind of remarkable, Andrew. You think these stocks are fungible, you know, they should trade the same way in mainland China and Hong Kong and here, and yet there is a differential. Stocks listed here, China stocks, down, different kinds of regulatory pressures that we're seeing.
There's a lot of risk on the duly listed names. I do like that those are the mainland China stocks. And again, it just comes down to a percentage of allocation. The large companies that we deal with, sure, they have 2-3% in China. That's not going to hurt them. But as an individual investor, do you really want to sell your Netflix and take a big bet on China right now? I think there's a lot of risk in that.
Well, what kind of allocation are you recommending to these big pension funds, the U.S. pension funds, right, and U.S. insurance companies?
Yeah.
They have global asset allocations now, too. Are China stocks investable or uninvestable at this point? What are they telling you?
I think the smart play is Europe. His hedged Europe is going to do really well. Countries where you can still get commodities weightings, right? If a company produces commodities, you can see that those are not performing, are performing better than tech heavy, like Asia can be tech heavy. So.
Yeah. You know, it's not just professionals, folks. Retail investors are having a very tough time figuring things out. Charles, one of the reasons I had you here, you are the American investor, the retail investor. The American Association of Individual Investors, which you represent, is a mainstream retail investor group. Your investor sentiment survey, which I watch every week, and been watching it for many, many years, showed 46% of respondents bearish. That is way, way above the average. It's about 30%. What's got the average investor worried right now?
You know, I think it's a combination of factors, Bob. The volatility we've seen in the markets is certainly playing a role, as is Ukraine. But you also have inflation, and a lot of investors obviously see inflation front and center. I think in the mix of all that, we also have the uncertainty of a rising interest rate environment. How much is the Fed going to raise? Right now, it looks like next week we'll get a quarter point instead of half a point, but obviously what happens after that matters. And then I think as I mentioned to you before, we also have this role of politics at play, where the political views come into play as well. And so those who maybe are more conservative, they're more dour on the markets, have a more bearish outlook in general. And we see a similar type of thing play out in the Gallup polls, where they look at how people view the economy by the partisan affiliation. That plays a role. But I think, you know, if you're an average investor, you're looking at higher food and gas prices, you're looking at a volatile market, you're looking at interest rates rising, and you've had this big run in stocks since the coronavirus bear market bottom. So I think it's a combination of factors at play here.
I'm always interested to see what your membership is owning these days. You did a survey recently of what your members own. You just ask them what they own. And I think it's interesting. We'll put this up. 91% own individual stocks. That makes some sense to me. But 75% own ETFs, more than that own mutual funds. I think it's 72 or 3 that own mutual funds. And here's something very interesting. Only 6% own cryptocurrency. Now, we make such a big deal of the Robinhood crowd because they seem to own nothing but cryptocurrency. And yet the average investor, I think of AAII as the average retail investor, only has 6% crypto. So this tells me ETFs are really making inroads into the average mainstream investor. And even more so the mutual funds. And cryptocurrency, while it's there, is still a pretty small business for the average retail investor.
Yeah, it is. And part of it at play is our demographics. Although we have a very broad membership of about 160,000 members, we tend to skew towards older investors. Our average investor is in their 60s or 70s in terms of age. And I've seen that at other organizations that target individual investors. So that's something at play right there. I think a lot of individual investors, when they look at crypto, they're still not quite sure what it is, how to value it, how to even buy it. So I think there's some of that at play as well, whereas your people who are, say, Gen Z or millennial are more comfortable doing that. But I think what you see in ETFs and stocks is I think you have a lot of people using ETFs either for broad allocations or perhaps to get to things like international or bonds. but that are using stocks. And what I've seen over the course of my career is people might be pretty mainstream with their mutual funds or ETFs going for index approaches, but then either they're tilting towards value, they're incorporating trading strategies, perhaps covered call options. So they're mixing the two, where part of their portfolio is probably more traditional, more conservative allocation, but then are using stocks to perhaps be more aggressive or supplement those holdings.
Single stock risk too.
Yeah, what were you saying?
Single stock risk. I mean, and COVID was, once we realized the world wasn't going to end, it was like, okay, buy stocks, right? And this is a far more complex problem. And I think, if you said it was older, wiser, or at least investors that have been around the block, let's say, and haven't just had a bull market, they're going, it's time to take single stock risk off the table and have some ETF allocations. That's where I think that growth comes from.
I wonder, Charles, and I realize that Russia's attack on Ukraine and rising inflation have put commodities into the spotlight. We've been covering commodities for weeks on end here on ETF Edge. But one of the things I always remember about you is you've always emphasized to the members, it's really important to do your homework before you add commodities to your portfolio. What is it about commodities that the average investor should be really careful about?
Well, I think when they look at ETFs or mutual funds, they need to be very clear about what they're investing in. In my latest commentary last week, my investor update commentary, I used a combination of looking at the Spider Gold, GLD, and then there's a Gold Bugs, which is an ETN, GBUG. When you buy Spider Gold, you're actually buying a trust. So not actual gold, you're buying a trust that holds physical gold. Versus the G-Bug actually invest in futures contracts. And so it's a case where you're getting exposure to gold two ways, but both times you're a little bit step away. And anytime you start getting involved in futures contracts, you have to realize those contracts are going to expire. They need to be rolled over. But even if you just buy a plain commodity ETF, it could be holding futures. It could be holding assets. It could also be holding individual companies. And if you're looking at individual companies, say Halliburton, Barrick Gold, whichever company you want to pick out, or Deere, you're looking at operational risk there. You're looking at stock-specific risk. So it's not really a case where you should judge an ETF by its name. You really should take a look, see what the ETF's doing, and even among commodity ETFs, see what their allocation is, because their exposure to precious metals, to energy, to agriculture might actually be different by the type of fund or the exchange-traded notes you're looking at.
Are you getting a K1?
Yeah, it's caused us no end of problems for years and years, explaining just rollover risk in owning commodity futures, let alone...
the bigger ones, the more risk.
Well, we saw that with the oil ETF. Remember what happened. Now, Arnie, let me bring you back in. You run, this is a slightly different subject, but I'm always fascinated with it. You run the Emerging Markets Carbon Reduction and Climate Improvement ETF. That's a mouthful, but the symbol is EMCR, and it basically tracks an index of emerging market stocks that are selected based on whether or not they're reducing their carbon footprint. It's sort of like a play on the net zero economy. But prices for these carbon emissions have collapsed. This is interesting in light of what's going on in Ukraine. Can you explain why that's happened and what impact has this had on the whole movement towards low or zero emissions?
Yes, Bob, this is actually a very interesting topic to bring up in the current sort of scheme of things. The topic of carbon reduction and climate risk, obviously before the most recent incursion onto Ukrainian territory, was really at the top of the agenda for many of our investors. EMCR is a fund that was launched relatively recently. In August of last year, we brought it to market. In a relatively short period of time, it managed to gather over $700 million of assets from institutional investors. So that goes to show that really there is demand for that kind of net zero type of carbon reduction strategy. And what EMCR does, it's not a thematic ETF. It's not an ETF that banks on, let's say, carbon efficient industries in any way, but it is very much a broadly diversified emerging market index that really seeks to track in a way any market capitalization weighted index. However, it also at the same time seeks to reduce the carbon footprint by 60% and have a year-over-year carbon reduction inbuilt to itself by 7%. So it is really something that, especially in the institutional investor community, we see at the top of the agenda. Of course, with recent geopolitical news, that agenda has shifted somewhat, very understandably. However, in the medium term, and most certainly in the long run, the topic of climate change and carbon reduction and the importance of carbon reduction strategies will for sure come back onto a broader agenda. I'm personally relatively sure about that.
So it feels like a double whammy here. I mean, I'm looking at this, what you own, Taiwan Semi, Tencent, Samsung, Alibaba. They've all gotten hit in the global slowdown, number one. But number two, I mean, prices for the carbon emission business in general have collapsed a bit because of what's going on in Ukraine. The emphasis is going to be on hydrocarbons now in the near future. I got that. So that's the two-pronged problem here, Arnie. Is it right? Am I right about that?
So just to avoid confusion, we're not actually trading any carbon credits or futures on carbon credits in our product. We just hold stocks. We're a long-only portfolio of emerging market companies. And yes, of course, that portfolio has suffered alongside the standard market cap benchmark. However, since its launch, we've actually seen a fair bit of outperformance, ever so slight outperformance, I should say, of EMCR compared to a market cap weighted benchmark index. So the suffering in terms of the carbon price has no effect really on our portfolio. We're still exposed to companies that have a plan to actually better their value chains for the purpose of medium-term climate change.
And is this going to change the whole conversation, the Ukraine thing, around the whole environmental discussion?
It should. I mean, ag tech.
I'm talking about ESG in general, but the E part of ESG.
I think it adds to that. I think we're going to be obviously, I think we're going to be not using Russian wheat for a long time. That's just my opinion. So you're going to have agriculture and carbon credits in agriculture is a huge trend. That's going to be part of ESG. We'll be talking about that next year, like it's the biggest topic around.
Yeah, I don't know where that's going to go, but it has to affect the whole ESG story, the whole environmental story somehow,
absolutely.
And the investing in ESG.
Yeah.
I mean, it always amazes me that when you look at these big ESG funds, they're always tech-oriented because, in a sense, they're like large growth companies.
Right. How do we get rid of this? How do we get rid of that? How do we stop doing this? That's what they're about.
It's very, very difficult.
Yeah.
Charles, any other thoughts on what the retail investors are telling you right now, what your members are really interested right now, other than trying to figure out what inflation is doing, which we all want to know?
Yeah, and the one nice thing is a lot of our members tend to be long-term investors. So I would say the one thing we do have, particularly among our members who are retirees, is really just that income portion of the portfolio. That's been a challenge for years, as you know, with interest rates being so low. And it continues to be a challenge. So while they might be worried about the impact of interest rates on the stock market, they're also somewhat relieved that at least, on the income side of their portfolio, they should be getting a little bit more in. And I do think there's a general sense that the Fed needs to raise rates just to combat inflation. But that is something they're definitely paying attention to. What are yields? And when can they be in a situation where perhaps they can actually count on something besides dividends to give them a reasonable yield and some cash flow?
Yeah, it's been noted. I've done several stories on this year. Record dividend payouts in 2022, it looks like. Record buybacks, it looks like. Record cash flow.
Yeah.
I don't know if capital expenditure is going to be in a record. That's what a lot of people would like to see. But certainly companies like the oil companies are going to get oceans of cash flow.
But there's risk. If you look at the HYG and the J&K, to stay on the ETF topic, outflows. There's, higher yield, more risk.
Yeah, that's simple. All right, everybody, fascinating discussion. Thank you very much. I know we've been all over the place, but it's just a lot of macro risk out there, so I wanted a lot of different voices in this. Now, that does it for this week's ETF Edge. My thanks to Arnie, Andrew, and Charles. We've asked Andrew to stick around and chat about broader ETF trends for our ETF Edge podcast coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.